Hello, everybody. This is Kirk Spano. It is Tuesday night, April 14th, for our little half an hour talk about investing in stocks. In case you haven't read it yet, on Friday, we're going to discuss the quarterly outlook and game plan. So if you haven't read it, I'd say read it a couple of times. I got a little tired editing it. I've been working on this for 2 weeks. And at one point it was 8,000 words, so I edited it down. And in the process of editing, I made a handful of mistakes that I corrected today. But I think that, I went out of my way to put some neat graphics in. So I got the alligator jaws, and I got put some neat red lines in. And we're going to talk about oil today. I explained a logarithmic line incorrectly. Somebody had to correct me on that, so I fixed that. Ooh, got helicopter money. Yeah, all kinds of stuff. How about this? Fed balance sheet under 1 trillion in 2006 to 4 trillion after the financial crisis to it's going to be 9 trillion by the end of this year, it looks like. Between 9 and 10 trillion. Who says you can't just print money? All right, so anyway, read this when you get a chance. The summary is, I think that we still have a lot of danger. There is one chart I'm going to pull up here, which is not easy to see, so we will pull this up the other way. I want you to kind of take a look at something. There we go. So this is the chart that I think that we have to build off of. So this is our S&P 500 chart. And, we take a look at different things. You have the financial crisis over here. My cursor is kind of hidden. Financial crisis, followed by the Fed easy money, quantitative easing era. They had one little period where they were talking about less easy money and the market got angry. So they went back to easy money. At least they didn't make it less easy. And we got cheap oil and tax breaks. Fed tried to normalize. Market got angry. And then something was going on in September. Somebody needed a bailout. So the Fed started their repo operations and had expanded their balance sheet by $1 trillion between September and January. So now the Fed is expanding their balance sheet by trillions and trillions to try to prop up the economy so that we could wait out this coronavirus thing and come up with therapies and vaccines. And it looks to me like the money flow into the market is going to be on a pretty exciting uptrend over the next couple of years. And, this is probably the wrong shape, but when I did it, it kind of reminded me of Batman. So I decided that Jay Powell is Batman. In any case, the stock market right now is in hard to know land. Should the stock market drop back and retest the lows? Historically, yes. Fundamentally, yes. But maybe nobody cares. And I wrote that article. So I think that by the end of the next presidential cycle, we probably see the S&P 500 between 4 and 5,000. So about a double from here in the next 5 years, 4 to 5 years. We have to decide how to get involved. And I think that we need to decide whether we think the bottom is in or not. If we decide that the bottom is in, and I think that we'll know by the end of next week, then we need to start scaling in on all the pullbacks again. Now, if we decide that the market has not seen a bottom, or at least is going to retest the bottom, then we might need to wait just a little bit and skip a level. The level that I mentioned a week and a half ago was 2710 to 2780 on the S&P 500, and that we needed to stay above that range back-to-back Fridays. Well, this Friday and next Friday, if we're still above 2710 and 2780, then we're probably going to see the stock market run to, probably right back to near its highs. Maybe a little short. We don't know. And I was just talking to a client about this. The problem with the stock market is that with so much intervention, price discovery has become very difficult. The reality here is that fundamentals haven't mattered very much except for a hot minute in March and a hot minute a couple of times in December and February of 2018. So fundamentals don't matter often, except when they suddenly do. And trying to pick those time spots out, we've actually been pretty good at it, but trading it is difficult. So you have to employ good trading mechanisms and understand that you're not necessarily there to hit a home run. It's nice if you do, but you at least want to open up a gap between yourself and the index, the S&P 500. If we can beat QQQ, we're superstars. If we beat the S&P 500, at least we're better than the person down the street. So we really need to consider where do we think the market is going in the intermediate term, because in the long term it goes up. And in the short term, we have to react. So in the long term, stock market goes up. In the intermediate term, it looks like the stock market is going to go up because you're going to see all sorts of spending again in the next presidential cycle, on top of a $6 trillion bailout, which is about double what we thought we were going to lose in GDP. So a $3 trillion loss of GDP, and that's my estimate, which is higher than almost anybody on the street, is getting a $6 trillion bailout. Think about that. Think about what that could do to velocity of money, which I talk about in the outlook. We could be setting ourselves up for a massive rally a year or two from now. Between now and then is the hard part, especially through, I think, the end of this year. And what we have to consider is, do we think we're going to screw up on coronavirus and let it ramp up again? Because it's just starting to flatten out. 2 million cases across the planet. That's a pretty good flattening. But it's still headed to 10 million probably in the next several months. But if the rate of increase keeps slowing down and slowing down and slowing down, we flatten out that logarithmic chart. And ultimately, because not a lot of people in one area are getting it, it doesn't spread as fast. And it starves itself out if the last person that has it stays at home for a month. That's what we think. One of the wild cards with coronavirus is we don't know if it can sit dormant in you for a while or if you can get it again. But we do know that people have tested positive several days after having tested negative a couple of times. Because you have to test negative twice before they call you cured. And maybe we have to change the definition of cured. HIV stays in your system forever. It might turn out that this stays in your system forever and you have to always fight it, like HIV. That's a pretty good reason to social distance, so that you don't get it and have to treat it for the rest of your life. So I'm staying hunkered down for quite a while. I'm not going to casinos or anything like that. The idea that people throw out there that there's going to be errors in the testing, not across hundreds and hundreds of tests. They're getting pretty good data on things like that. So what we have to figure out is, why is it coming back? Was it never gone in the first place, or are you getting it again? the point is we don't know those things yet. So caution is the name of the game. And whether you're the World Bank or the IMF or the United States Treasury, everybody is anticipating that this is going to be far worse than the Great Recession and probably is almost as bad as the Great Depression. The difference being between the Great Depression and now is we're using all these monetary and other money creation tools to support ourselves. And you can hear, you just in the background when you read the tweets and the messages of the people saying fiat money, fiat money, fiat money, fiat money, fiat money, you should laugh at them. They beat their drum, fiat money, fiat money, fiat money, fiat money. You know what? The United States is so rich that it wouldn't be a sweat. If we printed $30 trillion to wipe out the Fed balance sheet and the national debt, it wouldn't hurt us that much. The dollar would drop down a little bit, but you know what? Everybody else on the planet will go, well, they did it, we're going to do it. So if all of a sudden there's this international jubilee to forgive debt or just pay it off with funny money, you get a one-time step up in inflation and you offset all the horrible deflationary forces that are in there due to demographics. Do not think for a minute that we're not getting more helicopter money at some point. I categorically guarantee you the Federal Reserve will never pay off the $9 trillion that's going to be on its balance sheet. Maybe they keep $1 trillion on there and they pay $1 trillion off and $7 trillion of it gets clicked away with new treasuries because, hey, we have to liquefy the international markets. So don't expect a lot of inflation here. Expect some inflation, but a lot of that is offset by the baby boomers retiring and the fact that Europe is older than us and retiring, and China is older than us and retiring, and Japan is the oldest country on the planet. Why those 4 countries I mentioned? 4 biggest economies, something like 80% of GDP globally. 85%, it's a big number. The only giant economy that is not old is India, and they can't get their act together. So they have slow velocity of money too and aren't contributing all that much to global GDP growth. In fact, they can't even figure out how to move their people around and how to house them. So, the caste system is strong in that country, and that's a darn shame because they have the potential because of their education and really their sensibilities other than the whole caste structure. They should be a powerhouse, and they are undercutting themselves not to be. In any case, for us as investors, we have to consider where do we want to invest? Probably the United States, a handful of international growth markets, but mostly the United States. The United States is the safest place to invest in the world. We are the strongest economy by far. Even though China is about the same GDP as us now, they do it with 10 times more people? I don't know. It's 5 times more people, 5 times more people to get the same economic size as us. So, don't ever think that the United States is going to hell or anything like that. Our biggest problem is we let a handful of people steal too much money. The big skim is in. So if we ever decide that progressive taxation makes sense when you get to a certain number and that regulating the financial markets makes some sense and that, the better safe than sorry approach on the environment makes some sense, there's just some basic things we have to take care of that for whatever reason, it's too hard for us. Bullshit. This is America. We can do anything. So, one of the things I was talking to my client about was healthcare. And I said, I didn't start my business until Obamacare came out. Having a good healthcare policy is very important for the economy. Why? Because it allows people like me to become an entrepreneur, right? I left my company 6 months after Obamacare started because I knew that I could have health insurance. I didn't have to stay at a company I didn't want to stay at. And I got to go start my own thing. Haven't made any more money than if I had stayed, But, I get to work from home and write my own hours and do my own thing. If I want to take a 2-hour lunch, I take a 2-hour lunch. I want to go golf, I golf. If I want to work at 11 o'clock at night instead of 11 o'clock in the morning, that's what I do. So healthcare has allowed me to be just as productive or more productive, and then I just get to go to the exchange. So whether the exchange is the best solution or not isn't the issue. The point is that good healthcare policy is another thing that we have to tackle. I think that in the 2020s, we're going to tackle a lot of things. I think the millennials, for as much as they irritate the shit out of me, are headed in the right direction. But man, you just want to slap them upside the head once in a while. And maybe that's just the whole youth and me getting to be a cranky old man, stay off my goddamn lawn, right? In any case, take a look at this chart, and especially this harp-looking thing up here. We're going to get a big rally the next several years. When does it start? By next year. And we have to figure out which technical levels are we going to get to. I still think between the red lines makes a lot of sense. Maybe it doesn't get to the bottom red line and it's closer to the top red line. That's probably where I would get most of my money invested, unless we get a major second wave of the coronavirus, and it looks like it's going to be trillions of dollars more that we have to fight off with lost GDP. Very simple story. This is where we want to get invested, maybe a little bit soon, and then if it gets to here, probably a lot at the orange line, and then for sure a lot at the first red line. Then down here in the bottom, whatever we have left in our bankroll. I actually was doing this chart for an article that I want to write. That doesn't look as good. And, people believe that dividends are the way to invest. Here's a list of dividend funds, and then the Invesco QQQ. Total return, and this is as far back as it goes. Oops, right here. So all these funds have existed back to the very start of 2011. So coming out of the financial crisis, QQQ, everybody else, including the index. So your dividend appreciation fund, VIG from Vanguard, your Vanguard real estate fund, your iShare dividend select, your Spider dividend, your Vanguard high dividend, your dividend achievers, your low volatility dividend, your iShares core. Nothing keeps up with QQQ because we go back to that whole concept of we want to be in the best industries, and QQQ is a collection of the 4 or 5 best industries, better sectors of the economy. So anything that's tied to the S&P 500 has got a problem. The biggest problem in the S&P 500 is oil companies, and they're getting a little bit of reprieve right now, but I think reality is setting in. Whiting Petroleum declared bankruptcy just a couple of weeks ago, right? 2 weeks ago or last week? It was recent. So let's take a look at just all the oil producers and integrated oil companies. This is a list of them. I tell you what, you should at least get the free version of Stock Rover. You can link to it from either one of my sites. It just is so easy to screen for stocks here. They have all these screens built in. You can build your own. I built this oil production one. You take a look, and you can rank by return on assets. Look at, nobody has a good return on assets. A couple here at the bottom. Everybody, Diamondback. Diamondback's one I said I think might make it. Occidental, no return on investments. Right, the Hess. Hess is one I just said sell. Contra was one that I said I think is going to hang in there, but they might need a strategic transaction. Devon. With oil prices in the 20s, and I think probably headed to 40 by year end, higher if there's a war, these companies just really don't have much of a future. One of the things to keep in mind with shale drilling in particular is that they did something called high grading. They drilled the cheapest, easiest to get to oil first. And I don't think that the second hardest oil, the second best oil, is going to make them any more money, given that oil prices are lower now, and that's harder to get to oil. If they couldn't make money with higher oil prices and the easy oil, how are they going to make money with cheaper oil and harder to get oil? Pretty simple exercise in logic right there, right? So I think that one of the trades that we're going to start to make, especially if we get a little bit more rally in the oil stocks, is we're going to start shorting some of these to zero. We're probably just day trading them, and we're probably going to use, there's one thing that we could do is you could buy puts on some of these stocks. The problem is that the stocks options are pretty expensive because a lot of people want to bet against them. So I think XOP, which apparently just did a reverse split. Is anybody paying attention? Did they just do a reverse split? They must have. So XOP is going to is having a little rally here, just a little one. And as this gets overbought just on the daily, I think that I'm going to start betting against the oil producers. I probably won't do it until I see whether or not there's a war in the Middle East in the fall, but this is something to keep in mind. And if this rally keeps going, I think this becomes an easy trade. In fact, I think that this is one that you put in your bucket, and we'll get an inverse version of this. But I think this is something you can day trade if you want to. Oil prices, on the other hand, which are still in contango, are probably likely to start drifting upwards. So we can use USO or DBO for that. All right. So just put this in, start, don't wait for me to tell you to do it. Do your homework on these now. Look at the companies that are the holdings in XOP. Start taking a look at the stock charts. Try to learn what a contango and backwardation are, because if we can buy calls on oil just as it's turning from contango to backwardation and potentially ahead of a war in the Middle East, this could jump up 20, 30, 40, 50% pretty quick. Maybe even double, right? Because oil prices are under 30 yet. So getting the price of oil to 60, it's probably take a war to do that anytime soon because the glut is so huge. But up to 30, probably if you're in backwardation, you can make a little bit of money on. So somebody wants to know about puts on SPY. So you take a look at your daily chart on SPY, and it's not overbought yet. But you take a look at the 4-hour, and it's overbought. You take a look at the 15-minute, which we've been using, and it's just coming off of overbought. So we don't have everything lined up just yet. I think that we probably want the 1 day to be closer to being overbought, the 4-hour for sure to be overbought, and on a particular day, we need the 15-minute to be overbought. I think those things all line up shortly, but I don't know that it's going to happen. So today or tomorrow, tomorrow or day after. There's levels that the S&P 500 is hitting right now that are pretty big support levels, resistance levels. So just a little over where we are now is a resistance level. There we go. That's what I want. Right here. We're right at some there it is. We're right at some resistance levels. 289, 290, 291, right in there. Hard, you have to try to figure out. People use Fibonacci ratios. Avi has his way of doing it. Kobayashi or whatever his name is, the other guy that I posted a chart from. Everybody has their counts for Elliott wave and their Fibonacci levels. I just look at the big things here. Look where the big humps are, where the trading zones are. Right, we're getting right on top of a resistance level. To pick out one number, kind of silly to pick out one number. You're never going to get it right. You're ballparking. So the ballpark here. Give you my shapes. Where's my shapes? That's not what I need. I don't know which one the shapes are. Icons, shapes, text, geometric shapes. There we go. So you go here. You say there's different levels of resistance. Highest one's about there. So anywhere in that area, there's a couple different resistance levels. And we just have to wait and see, okay, does it hold? Does it break through this zone? I think, anywhere in here, you're kind of in no man's land. I don't think there's a trade to be made. So if you're not getting a setup, don't make the trade. Wait for your 1 day, your 4 hour, and your 15 minute to all be aligned, all overbought for, at the same time for some part of a day or two, and you should get your pivot, your reversal. Do I think we get all the way back down here? Right? That's the big question. Do we get back down to this orange line? Because I put this orange line here, months ago, right? And look how close it got. I mean, look how close it got. That's pretty good. So we have one great day. This is the day. That was the day. Oh, well, we didn't know. It's okay that we didn't know. So now, institutional bias every now and again gets a real thin line. I think that's what this is going to be. I don't think the institutions are going to pile in here because they were late to get out. I just don't see them selling in here to buy over here. Why would they do that? And the family offices aren't buying either. So I just think this is a wait and see moment for the next week or two. And I think that just sometimes you have to do that. In the meantime, make your shopping list. Go to the article where I talked about the companies that aren't in the S&P 500 but should get there soon. I think those are the companies I'm most interested in. We take a look at the dividends, and I know that people like dividends, and I give you the best dividend ideas I can, but you're never going to make as much in dividends and in income as you could just investing in the best sectors of the economy. Get involved with the best sectors of the economy. Stop chasing dividend yield. If you're getting a 1 or 2 or 3% dividend on a Microsoft or an Apple, isn't that better than getting 8% on Exxon? Think that through. So, it's nice to have a little dividend. It shows that they're doing the right thing. And a lot of these companies buy back shares instead. And on the NASDAQ, like I keep saying, those companies have 70%, give or take, of all the cash on corporate balance sheets. There's a whole kinds of bad dividend payers out there that are borrowing money to pay dividends. They have some tough business decisions coming up. Some of these office REITs, they're going to have problems. The malls, they're going to have problems. There's a lot of chain stores that are going to have problems. The Amazoning of the world is going to take off even more. And there's actually a company here in Milwaukee called Quad Graphics that is kind of moving in that direction. And one of our subscribers owns the stock, and I've actually known some of the people over my years here in Milwaukee. I don't know what to do about that. I think I'm going to call them. I'm going to call Quadracci because this might be a small cap that could be a 10-bagger because it got the crap beat out of it, and it's in a business transition. And what do we know about business transitions? Sometimes that's a great time to buy. Not often, but sometimes, right? Because usually turnarounds don't turn, but sometimes they do. And if you can find one that does, Exact Sciences, maybe it goes up 1,000% for you. So again, just a regular cold. I still have my insurance, my pie, my puts, excuse me, pie. I'm thinking about pie and ice cream. My May puts, yeah, I still own those. Those are insurance. Those are insurance against a long part of my portfolio. Now I've liquidated some more of the long part of my portfolio, like some of you mentioned, have also done. I'm just not terribly excited about being very involved in the stock market right now. We need some clarity. Is it off to the races? Really? Are we really melting up to 4,000 on the S&P 500 in the next year or two? Or do we have to have some sort of a pullback? I can't imagine that we don't have some sort of a pullback given how bad the economic and financial news is going to be. However, I don't doubt that we're going to open up the economy too soon. So how do those things play together? Maybe we get some hopium, right? Do we get some hopium? And I don't know. Do we get hopium? I think we're gonna get some hopium, right? If we get hopium, we have to be real careful because it's elemental number, right? It's periodic number 104. It doesn't exist. Right? It's not really down here. So be careful with hopium. I do think that we're going to see a lot of zombie companies in the S&P 500. That's why I just don't want to be too involved with that index. We have to be involved in the disruptive companies, in the companies that are actually generating cash, the companies that are more attuned with the work from home, drive less economy, the delivery economy, the just-in-time delivery economy. One of the things is we could be short almost all the stocks, all the restaurant stocks, because even the ones that are delivering aren't making money right now. But think about what happens to people's behavior over the next year, because we're going to have some form of social distancing for another year. It might not be as severe as it is now, and we're going to have to develop better manners. I can't walk around coughing on people, but there's got to be some winners in food delivery, right? And maybe things like Blue Apron actually finally take off. I don't even know if they exist anymore. But think about the ideas that you think will do well. Coming out of this with people's change of behavior, and think about what you don't want to be invested in. It doesn't mean you have to short it. Just stay away from it. Don't be in funds that own it. And don't invest in stocks that have to go back in time to survive. If a company needs a time machine, right, Back to the Future car to do well, it's probably not a stock you want. I think that Exxon is going to $10 a share, maybe lower, but I think that they break the company up at some point. So there's a lot of bad stocks out there, but there's a lot of good stocks too. And ultimately, the American economy does fine. We're just getting through a rough patch. I have a lot of faith in our biotech and pharmacy industries to some extent, but really the biotech industry to find a solution for coronavirus. I hope that it's not something that you have to treat forever. That's the thing that I think is not getting talked about. What if it's like HIV and it stays in your system and you have to treat it forever? Think about that the next time you're not practicing social distancing. We might need this vaccine more than we think. So I would tell you, be cautious. Wait till we really know. Stop reading conspiracy blogs and Zero Hedge and some of the other things that are out there. Right? An ongoing treatment would be good for biotech. And that's why I said a week or two ago, I think we're probably going to add a biotech ETF to our mix. So between IBB and then ARKG, right, ARC Genomics, those are the two that I'm looking at, large cap and smaller cap, mid cap. So, yeah, I think that we have to consider that in the dawning age. And I'm just going to throw this out there. You can believe it or not, but I was a science guy back in college for a while, and nature has a way of winning. So we need to be real careful with nature. Climate change is having unexpected consequences, and we don't have to argue about why climate change is happening. It's happening. We don't have to argue about why, but it's happening, and that means certain things will change. The oceans will change. What's living in the oceans will change. Viruses will change. So I think biotech does become one of those sectors where we probably ought to get geared to it a little bit more, and then semiconductors. Semiconductors, and I don't know if I have this chart up or not. Oh, I was playing with charts all day, trying to find correlations. Oh, yeah, here. I did have it out. So these are the top funds, ETFs for the last 5 years. Only 4 criteria: expense ratio under 0.79, at least 30 holdings, a dividend yield over a half point, and some volume. And American. And I'm not looking at international. What do you see? 5 years. Semiconductors, tech, IT. I think you're going to see, this one surprised me. I didn't know this. Global gold miners have done really well the last 3 years in particular, but also the last 5 years. QQQ, basically the benchmark for us, right? QQQ is our benchmark, right? SPY is everybody else's benchmark. So if we just meet our benchmark with lower risk, we beat everybody, right? Because of this. So gear yourself to QQQ and trying to either A, get QQQ performance with less risk, or if you're willing to take, just a little bit more beta, try to make more money. So, having a slug in semiconductors at some point, which I think the next pullback, I'm for sure buying this ETF and some NVIDIA and maybe some Micron. It's just, that group is just so good. But then as you go down here, GDX has done well the last couple of years. Then you finally get down to some of your, SPY is in here somewhere. It's not even on the first page, is it? Find SPY. Let's see here. I don't see where it is. SPY G. So SPY is not even on the first page for 5-year return. So if we stick with funds here, this is how I pick them out. I mean, I just screen, see what, who's doing well where, take a look at beta. Your semiconductors are going to have the higher beta. That makes them tradable. So this is going to be something that we get very, very used to in the trading room over at Fundamental Trends. So this should be on your list. SOX should be on your list, right? Upward trend, buy it, back off, buy it, back off, buy it, back off. I don't think you ever want to short it. That's just too dangerous. But, I think the ins and outs, right? Get in, make your money, let it top out, back off for a couple days, then get back in. I think we're going to do a lot of that, right? If we can get most of the step ups and avoid most of the step downs, you can increase your return by 50 to 100% over a year versus whatever this does. Can you imagine over the next 5 years making 300% on this and being out a lot of the time, right? Because overnight is when bad things happen. Nice to have cash overnight in case you wake up and the world is hurt. So, we'll take a look at things. I'm going to do the chart books finally this week, and they're going to be quarterly. If you are looking to do any type of trading at all, you need to subscribe to TradingView, which I have links to get you a couple bucks off, or something similar. You need to be able to pull up these charts when you want to pull up these charts. It doesn't make sense for me to just keep on popping up charts. And I don't spend all my whole day popping these charts up, right? When I sit here during the day, I go like this, I go like this, I go like this, and I go like this. Just want to see if and the daily one doesn't chart change off it, so I don't have to. The 4 hour and the 15 minutes are pretty important to keep up on. I'm not gonna tell you when this happens. If you're trading on a particular day, you have to have this or something similar. Stock charts, whatever you want. I like this setup. I used to use Money Flow Index, by the way, and I'm using it again because I think the volumes are telling it really. This is volume weighted, and I like that. I think this tells us a lot about which way the money is moving in very real time. I think Shake and Money Flow is close, but it might be just a little slow, maybe by a day, or by a time period. But and then MACD, obviously, you need to know how to use, and then this moving average, this weighs moving averages down here, and this is unique to TradingView. I haven't seen it anywhere else. So it's 3 different moving averages, and when they head down, you need to be careful. Look what's happening right now. So when it goes underwater here, it's when you're gonna see bad things happen. So take a look at here. Slowed down, went negative, started to improve, and bam. So it's pretty good indicator. Do it on the 1 day, and it just look, crossed over right here. Look at that, fell out. It was a waterfall. So is this going to keep going up, or is it going to turn back down? That's a pretty good important question to ask. It could be one more day before it peaks. We could be 1 day from a peak in this market, because this RSI could get real close to overbought. This is already just about there, and this is there too. So if this 15-minute, if this market rallies tomorrow, but stalls at like 29, 290, yeah, it's a pretty good signal that maybe it's about to turn back down. So we just keep an eye on these. We can start figuring this out. You're never going to be perfect, but you keep an eye on this stuff, and maybe you can find, excellence. And that's we'll close on that with a Vince Lombardi quote. That's what that was. All right, everybody have a good night. I'll talk to you Friday. I'll see you in the trading room at Fundamental Trends in the morning. Stop in, post the charts that you're using. I would love to see it. In the forum, post questions of a fundamental nature, and we can put up our research. If you have research from a brokerage, and I know all of you do, that you should have a folder on your computer for every stock that you're looking at where you drop your research reports from your brokerage into. Drop those same research reports over into the threads in the forum at Fundamental Trends, so that we have our own little historical library, and then we can see how these reports change over time. And there's some value to that. I am looking at Centio and Y charts right now. I don't know if I'm going to take either one. Centio has some pretty cool AI, but is expensive. And Y charts, they upgraded me to the Pro version, just so I could test it out. I want to see if the correlations help me. But what I was really looking for is alternative data sets, and they're just not out there. So you can find alternative data sets to attach to the fundamentals of a company. It's pretty powerful, but getting that information is just ridiculously hard. Even Bloomberg doesn't have it. So What I refer to as alternative data sets would be the number of cars registered, right? The number of Teslas registered, um, the number of clinical trial patients who are, completing a study. There's all kinds of data out there that you can be looking for that is beyond what you find here, right? Because I like Stock Rover, but the honest truth is there's 10 places you can do this. The data that you want is more granular. It doesn't get baked into the financials. It's the business data. It's the things that move the business. And if you can find that, you're going to have an edge up on everybody else. Remember we talked about something called scuttlebutt, right? Scuttlebutt is the slang. Basically, had to do with ships, but scuttlebutt also came from common stocks for uncommon profits. So if you have never read Common Stocks for Uncommon Profits, you probably should. This book was one of the ones that Buffett talks about. If you want to learn about companies, read this book. There's a checklist in it, and you find out how to look for information better. It's not all screenable. You need to learn what the businesses are about. And ultimately, these QQQ businesses have a lot going for them. So that's the easy thing to look at. But if you're going to find home runs, you're going to need a little bit more than QQQ. You need to find the companies that are going to get added to QQQ and the S&P 500, which is what I started focusing on again after a layoff. All right, have a great night.